Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, I'm thrilled to be joined by Vice Chairman and Chief Economist Don Rissmiller. Don, how are you doing today?
Very good. Good to be here.
Yeah, thanks for jumping on with us. There's a lot of places we could go. I want to start with the consumer picture. It's a huge part of our economy, and recently we've gotten some data that suggests confidence is weaker. We know that inflation is higher. That's a headwind to the consumer. But we also know that spending has been pretty strong and that consumer balance sheets are pretty healthy given some of the fiscal stimulus and some of the other factors. So, given the size of its importance to the economy, how are you thinking about the consumer picture at this point in time?
Yeah, it's an important question, again, given how important the consumer is to GDP. Now, we've come through some pretty strong numbers. If we look at the first quarter and second quarter inflation-adjusted consumer spending numbers, they were above 11% quarter to quarter annualized over the first half. So that's a very aggressive pace. We should slow down from that. So that's not surprising. But the August data, where we saw the University of Michigan survey of consumer sentiment fall, where we saw the Conference Board survey of consumer confidence decline, those were notable. And that was something that is more extreme in its drop than would have been expected, let's say, 4 to 6 weeks ago. So what that's picking up, it's picking up renewed concerns on the health front, the Delta variant. It's also picking up some concerns about inflation, which has also run quite aggressively above forecast over the past several quarters. And so the consumer from here is in a place where we're entering an air pocket that we have to be concerned about for a short period of time. The big issue is, if we dig into the consumer spending data, what's elevated is goods and what's been depressed is services. And that likely has to reverse. And so the smooth pathway for that to reverse is for goods to slow down, but services to pick up and provide a nice support for overall consumer spending. What the drop in sentiment is telling us is that may not be as smooth as we would like or as we might have expected a few months ago. So we have to get through some of the health concerns. There is a pathway. There are medical interventions that are out there and can help. They're just not happening at the pace that we might need to see to have a completely smooth trajectory on consumer spending. So again, because consumer balance sheets are in decent shape, this doesn't have to be a financial crisis. It doesn't have to be something worse. But I think we have to expect that this is going to be bumpy for a few months until we resolve some of these transitory issues.
Sure. And you mentioned the services sector. I mean, that's kind of been the epicenter of this whole crisis, right? On the consumer front, on the jobs front, you think about hotels, travel, restaurants. And so we're recording this on Thursday. We're going to get a big jobs number tomorrow on Friday. And the services sector is again expected to be in focus because a lot of those jobs are still missing from the economy. As we approach tomorrow's number, how are you thinking about the labor market? How are you thinking about its relation to the Fed? Where do you all stand on that front?
Yeah, so we're coming through several very strong months on the BLS labor market data. So we added close to 1 million jobs a month over the last 2 reports. And that type of pace was probably enough to make up for some of the fiscal drag that's coming. The question is, can we keep it up for another 2 months? And that's what just got harder after the drop in consumer sentiment. Now, jobless claims are still in a declining trend. So the labor market still looks to be generally healthy. If we look at job openings, they're still quite elevated. So there's reason to expect a healthy labor market over time. It's just this August-September period, as we deal with benefits rolling off, as we deal with schools not reopening smoothly in all cases, as we deal with renewed health concerns on virus variants, we're entering the same type of air pocket we're looking at with consumer spending. There's good reason to think the economy can get through this, but again, it's a choppier trajectory than it looked like just a few weeks ago.
To be sure. So I want to end on a last question on maybe a more positive note. So you've written a bit about kind of this mini productivity boom we've seen. So some efficiency gains made during the pandemic that might actually be sticky as we move forward. The productivity numbers are elevated. You see profit margins near record highs. Do you think we could be entering a period where we have a bit of a productivity boom after a decade plus of kind of lagging on that front?
Yeah, and that's really for the long run, the important question. And so we touched on the Fed in that prior question. I didn't fully give an answer to that. So I'll just start off by saying the Fed is in a position where they're dealing with some supply constraints, and that's not the best position for them to be in. So some of the tools they might use, like quantitative easing, are meant to boost demand at key times. So that's really not what we want to do here. So for the Fed to back off and say, okay, maybe we need to taper QE, but keep interest rates low, is going to become a reasonable position for them. For the private sector, the question is, can that type of trajectory where the Fed takes their foot off the gas but doesn't push on the brake, where they set up an economy with those inputs, can that yield productivity? So when the Fed creates money and gives it to the private sector, is the private sector productive with that money? If the private sector is productive, we get goods. If the private sector is unproductive, we get inflation. And so the productivity question for the long run, for the next several years, is quite important. Now, like you said, we have come through a decade where productivity was relatively weak. So we have seen over the past year and a half some change in trajectory. It's probably premature to say we're booming, but there's a story that wouldn't be hard to tell. Higher value added services, finance, healthcare, technology have created a remote working environment that could persist. And so if we have a situation where there's less commuting, where there's more time for other things in the economy, you could see how this could work. And so have we jostled loose some change in productivity that really is using existing technology? Some of the technology existed 2 and 3 years ago. It's just using it to get to business process. And that's really what's been missing. So the early data is encouraging. We can say that. There are some models that are maintained on the New York Fed's webpage. It's Kahn and Rich have done a productivity model that is updated regularly. And it's saying that there is some early evidence that productivity is changing trend and moving up. Again, we'd like to see another several quarters of this. We'd like to see this persist. But what we can probably say today is we're seeing some of the most interesting things we've seen in a decade on productivity. And that really is going to be an important question for the durability of this cycle.
That's great news. Well, Don, thanks so much for the time, and we'll look forward to chatting with you again soon, I hope.
Sounds great.